as we go into 2026, there's a lot of topics that could be potentially like business altering. So mainly interest rates, FX rates, and a lot of geopolitical risk. We're not politicians, we're not economists, but we do have a view on how that'll impact SMEs over the next year. So we wanted to put together a quick guide just to signpost some of the key events, economic indicators, and sort of key forecasts, so that finance directors and CFOs, owners of UK SMEs, have like a brief read, something they can pick up, flick through, and have a bit of an idea of what's going to happen potentially next year.
So looking at interest rate expectations for the coming year, we obviously had a rate cut last month in December, which was fairly well priced in. But Tom, what's your view on this currently?
Well, I think like, it's important to remember that like back to zero isn't the plan for the Bank of England. However, gradual rate cuts over the next year are widely forecasted by economists and banks. I think if you look at like sort of median term view, mid threes, so 3.5% by sort of end of Q2 2026 isn't out of the question. Potentially into the low threes, but I think when you look at the yield curve, when you look at some of the forecasts that are out there, you look at the key indicators that are going to change the Bank of England's mind. It's inflation, consumer confidence, employment numbers. Most importantly, inflation. I think between 3.25 3.5% is probably a nice area to benchmark for the end of next year. I think if you think about UK SMEs and how this impacts, anyone sat on significant balances, it's going to impact the drop through for potential treasury yield and interest revenue. Anyone looking at restructuring debt, it's obviously going to change, not super significantly, but it will change the cost of that debt over time. But really, I think forward-thinking finance teams just need to be thinking ahead around, where are they now on each of those products? How can they mitigate any risk that's coming up in the next 6 to 9 months? And how do they sort of keep on top of the economic events and indicators that are going to drive some of that decision making? Just to have it in the back of the mind, something to keep an eye on, not to lose sleep over.
Yeah, and half the battle with this stuff is just being proactive, right? There's a lot of there's a lot of there's a lot of pressure on finance teams to deliver projects and very time sensitive objectives, and things like treasury management may fall to the bottom of the list, similar to FX as well. So it's being able to put that plan onto a page and activate it alongside someone like Stable as the advisory partner.
Yeah, I mean, Treasury yield's a great example of, I think many FDs over the last 15 years have sort of grown up in a low or no interest rate environment. It's, not used to seeing a interest yield line in their accounts. And I think over the last couple of years where we've seen an increase back to more normal levels, it's almost been inertia and a little bit of sort of inexperience of what to expect to be paid from their banking partners. And I think for some businesses we see they've got a phenomenal treasury rate strategy. They have diversification across multiple banks and products, and they have like great yield. For others it's well, we've been with our bank for 20 years and our money's still all sat in one account, and we get 1.5% under base, which is worse than some personal current accounts. And I think it's not a lack of skill set or a not caring. It's more as a strategic focus. It's really really hard when you've got the rest of the business to run. To you don't have teams and teams of people looking at this in UK SMEs at the moment. When you've got 10 things on your plate, where do you put increasing our interest yield? I think it's an exercise that everyone should be looking at in 2026 as a small quick start project, benchmark, diversification check. We can help with that, but also best practice just to figure out where are we putting our money, how are we working it, what could that mean by the end of the year. And for some businesses it might pay for the Christmas party. For others, it's multiple hundreds of thousands in interest yield that they could be leaving on the table.
Yeah, yeah, and especially if you look at the rate predictions for this year, if it's not something you prioritise now, as those rate cuts start to creep in, and potentially that revenue centre from interest becomes smaller, it will become less relevant anyway. So like now is quite literally the best time to pick this up, particularly when I know from my experience the first couple of weeks in January can be quite quiet. There's still a bit of a hangover from the Christmas break period, and people are getting themselves back up and running. So it is, as you said, it's the perfect time to start benchmarking and maybe looking at some of those lower priority tasks that can make an impact, that will become more tricky to focus on later in the year.
Yeah, big time. I think if you were to ask the sales team, like, how do you make an extra 25 grand this year? How do you make an extra 250 grand, an extra 2.5 million? It's hard work, grit, determination, effort, marketing mix, target accounts, everything falling into place. If we can go and negotiate with your part of the bank or look at other options where there's better yield, in the space of 24 hours, we can turn on an extra revenue stream that we're currently not seeing. So it's definitely worthwhile. The juice is worth the squeeze, as they say. When we look at some of the key dates, obviously we've got the monetary policy decisions and monetary policy reports coming out. There's a list of those in the guide. We've also developed an economic calendar. We've got a QR code where you can effectively download all of the key economic events for UK for the following year. Pops it straight into your Outlook calendar or into your iCloud calendar. Just 9 o'clock or the timing on the day of the release, just with a short notice to why it's important, what it could change. Think again, we're not looking to overwhelm our FDs, CFOs, owners here. What we're trying to do is create a touch point of, it's inflation today, it's retail sales today, it's job indications today. If that's going to impact interest rates, if it's going to impact FX rates, what do I need to think about this week? How should I position myself for that? Just to give people a bit of a head start.
Yeah, and from some of the key data releases as standalone items, they might not be particularly market moving, but when you compound them over the course of a quarter or 6 months, then it tells a much more compelling story to the market, and that's when you start to see bigger moves in the currency pairs that you might be buying or selling. And as Tom said, the purpose of that is to keep your finger on the pulse and not allow that narrative or that story to run away too far into the year.
So Ali, next section of our guides around FX rate expectations. Obviously, the last couple of years have been relatively choppy for the pound. What do you see moving into 2026?
So if we take a step back and look at the FX hedging mandate piece we released a few weeks back, one of the most important things to consider when looking at FX rates and forecasts and expectations is that there is a really broad view of opinions out there. Bloomberg typically release a prediction at this time of year that has all the major investment banks, which potentially has some of the brightest analysts in the lands. And if you look at their views on sterling and dollar and euro between now and the end of Q4 this year, there'll be a huge divergence in where they think the market will go. And typically by the mid-year point, they will all have rewritten or reforecasted their figures, which can make it very, very difficult to plan. But the idea of trying to predict where FX markets may be, is really, really challenging. But what you should be looking at is having an FX strategy or a hedging mandate or a plan that allows you to accommodate for some upside in the currency pair, but also have a plan if the market continues to move against you. And sterling dollar last year in January was a great example of this, where previous year we'd had rates nearly at parity off the back of some of the COVID market fluctuations, and sterling dollar trading under 120 is quite an uncomfortable territory for a lot of UK businesses that are buying stock from China and other parts of Asia, and the market was starting to head towards 120. And I know a lot of companies were pressured into taking out products to cover them, maybe for for 6 months or a year, not because they planned for it, but because they had no plan and they were all of a sudden acting out of fear. And 6 months later in June, there'd been a significant rally, nearly up to 140 on sterling dollar. And that's just a good example of analysis being maybe off the boil or completely wrong in some cases, as there's some larger economic event which is unpredictable. But having that plan that allows you to cover certain aspects of your risk for certain periods of the year will give you a framework to make better decisions when you have got a really volatile market, which we live in now. That's the reality of it.
I think 2026, in summary, there's a lot pegged to interest rate divergence, convergence, significant change in UK fiscal credibility post-budget. I think there's a lot of hands sitting in Q4 last year, waiting to see what the budget outcome was going to be. One thing we can't discount, obviously, is like geopolitical shock. I think, 15, 16 years ago when I started on the trading desk at Travelex, we would sit around and talk about black swan events being a 1 in 100 year event, and they seem to happen every 6 weeks at the moment. So, I think 2026 for our UK SMEs, it's about how do we take out some of that risk. If we try and play the market and get the best rate, and am I winning versus where I could have booked, where I have booked, I think we're in some very stressful, sleepless nights. And to Ali's point, I think having a hedging policy, understanding your risk, understanding what level of risk appetite you will have and want to take, and executing in a disciplined way on that is the way to play the market in 2026. That being said, I think there's a broad view that we should see US rates drift lower. We should see potential euro strength, and UK, I think pound very interest rate driven at the moment, but mostly been driven by those two big pairs and geopolitical events.
Yeah, and politics is probably going to be one of the major contributors to extreme volatility over some of the economic pieces as well. We've had over the last 5 years some very very large movements off the back of elections, and I think it's fair to say that this year will be full of surprises, which again plays into the fact that you have to have a plan for surprises and work out how you, as you said, how you mitigate some of that risk.
So here we've got some bank forecasts for cable for 2026. See Bank of America there at 145 by the end of the year, all the way down to Wells Fargo 131. So, that's quite a significant swing. It just shows that if we knew where the rates were going, I think to the point of the title page of this document, if we had a crystal ball, Ali and I would be sat on a yacht in the Bahamas right now. We wouldn't be filming this video. So, I think the message here is that there's still a fair degree of uncertainty even amongst economists and banks around where sterling dollar can end up by the end of the year, and I think having an effective strategy in place will help mitigate any of that. And then on sterling euro, you've got ING down at sort of 111. So as we look at forecasts for next year, I think the main thing to recognise is that we've only got a few of the bank forecasts in here, but it sort of shows the divergence in opinion. So you've got Wells Fargo at 131 on cable by Q3 of 2026, and you've got Bank of America up at sort of 145. And what that really signifies is that if we had a crystal ball and if Ali and I knew where the rates were going, we'd be sat on a yacht in the Bahamas. We wouldn't be doing this video. So I think there's a fair degree of uncertainty still as to where rates could end up, and having a plan is more important than trying to beat the market. When we look at euro, again, you've got ING down at 111, you've got Bank of America up at 119, so quite a significant differential there. But again, these are the real sort of the 1%, the profit margin that could make or break a deal, could really put you in a nice place by the end of Q3, or struggling to fill the gap in Q4 if we get this wrong. So I think when negotiating contracts this year, we're negotiating long-term contracts, particularly if you're working with, in the food sector, the supermarket industry, or anything where you're putting a price on a product for a longer-term date. That currency monitoring, that currency volatility is a real factor that we have to take into account.
Yeah. See if I can.
One of the pages we're really proud of in the guide this year is the finance as a revenue centre. One of the conversations we're having quite a lot, and a big change in finance functions over the last 5 years has been this drive to become less known as the bean counters, the number crunchers, and be more commercially focused, more of a revenue driver. Something that Steve and I focused on throughout our career, working hand in hand as commercial and finance, to drive revenue into the business. I think few ways that we've highlighted that finance can act as a revenue centre in 2026. Firstly, opening up new payment channels. I think we're seeing now, especially where businesses are struggling with cash flow, open up different ways to pay, whether that's either via currencies, via different methods like card or pay by bank. These allow your customers more flexibility. Seeing a big trend in SMEs wanting to pay by corporate credit card, either for cashback or for additional payment terms. And those businesses which can do that with a virtual terminal and sort of negotiate a good deal, open up that payment channel can really shorten your AR cycle and really give customers no excuse not to buy, and really sort of allow your customers maximum possible potential to buy your products. Secondly, exposing hidden costs. So again, I think with more and more offshore services being delivered by global multinationals, there's a lot of hidden costs. So great example is AWS. Like many businesses have a monthly AWS bill. It's calculated in US dollars and then converted to a sterling payment each month. So effectively, you're suffering from currency volatility, and also quite a hefty currency surcharge on that conversion. But because you're being billed in sterling, it's often hidden because those usage figures sort of hide, that sort of upfront billing. Again, just diving deeper into the billing process, seeing if you can get that in a straight US dollar format, hedging that at the start of the year can strip out a load of risk and again just create a cost-cutting exercise that's relatively quick and easy to follow. Thirdly, finding additional working capital. I think one of the big things for UK SMEs this year is taking your opportunities. I think while the market has struggled, particularly over the last 6 months, consumer confidence has been relatively low. Any opportunities this year, have to take them, and finding additional working capital from more sort of want to say alternative methods to get product in people's hands or to launch in new markets quicker and beat competition is going to help. Another one is benchmarking the current infrastructure. So many businesses speak to, they're too busy doing their day-to-day business to worry about a relationship they've had for the last 10, 15 years. What we tend to find is over 3 or 4 products that the finance function take, there'll be some cost inefficiencies. Finding those, renegotiating or getting better features or terms, definitely helps. And then finally, the straight through to bottom line, increasing treasury yield. There's some really good products out there now for UK SMEs, specifically around diversification and yield, and an exercise just to look at how you can increase yield. It's a relatively, once completed, it's a relatively hands-off exercise to just drive additional revenue straight through to bottom line.
Yeah, and benchmarking can be quite a challenging concept in itself, because if you've got an account with Lloyds that you've had for 10 years and you want to benchmark your your FX rates or your interest rate account, like what are you going to benchmark it against? If you go out and start having conversations with new providers, then you won't always get a realistic quote or a figure from them. You'll be given a screen rate or a card rate, and then you could go off on this long journey that doesn't result in any tangible gain, and again just wastes more time. So one of the benefits of having Stable on board as an advisory partner is we have all those providers set up, we have good relationships with them, people that we worked with in the past, and we can cut through all of that noise and administration and come back with a score effectively about whether that product is is optimized, whether it's costing the business money, and effectively how you can fix it with as little effort as possible.
Finally, in the guide, we've got a view on what's happening in lending in 2026. I think Steve talks here about the withdrawal of Lloyds from the IF market, and there's been a broader high street bank exit from SME finance over the last sort of 5 to 10 years. We've seen in approval rates being particularly low over the last 3 years. It's harder and harder for SMEs to find cash. Um, there's significant tightening of underwriting standards. It's harder to get approvals at the moment. So, figuring out what you want, why you want it, and then really ensuring that your accounts show the strength of your business. I think some of the tax traps people fall into of trying to, pay the least possible tax. Great, short-term gain, long-term actually makes it very difficult to lend or sell the business. And, I think having a forward think around some of the practices that we're employing at the moment, are they future-proof for the growth of the business, for what we want to do and the outcomes we want to get to in the next 5 years? Secondly, a growth of like hybrid or asset-backed solutions. I think, there's a great sort of stock term loan type replacement facilities at the moment that are out there, things that typically your high street banks wouldn't be entertaining, but third party providers would. And for businesses carrying significant stock, as an example, there's some great like asset-backed lending facilities that can be bought against stock. Again, something for people to look out for this year. And again, there's a massive expansion in the lending space of the fintech ecosystem, which is creating more opportunities, faster speed to market, and replacing really what used to be the job of the local bank manager. And then again, we're seeing data-driven credit and ESG integration. So now a lot of the loan offers we send out, providers are asking for open banking connections rather than physical bank statements. We'll see more of that this year. And rate pricing volatility, I think, as AI enters, fintech and lending, as the computing power of these businesses gets better and better to understand risk, we should see price volatility potentially increase, because risk can be repriced quicker, more selectively, without the overheads that it did sort of 5-10 years ago, and that might drip through into positives and negatives for UK SMEs. And then to finish off, we've put in a couple of benchmarking exercises, so cards, a bit of a process to follow of how to benchmark all your card acquiring, and then following on FX also. And these really are just to show you that actually, the process is you're more than capable of doing it yourself, but if you were to push that over to stable, we would effectively take a lot of that back-breaking work away from you. But we would strongly advocate that, in 2026, start of the year, going through all your financial services suppliers, benchmarking versus where you could be in the current market, just understanding where there's potentially leaving some margin on the table, and running through that exercise is like a good, general hygiene piece to complete at the start of the year.
Yeah, and I think to your point earlier as well around cards, customers are expecting or want more ways to pay, and there are loads of solutions out there. Some are more suitable to specific buyer profiles than others, but again, without having to spend hours and hours of time going through and screening them and understanding what the propositions are and having to go through all the different sales pitches that will get thrown at you, we can again help cut through that noise and understand what it is that your clients look for, what's going to speed up the payment times, reduce all the friction that's involved in changing your payment channels, and again come back with a solution that we can roll with as quickly as possible. So traditionally with benchmarking on FX, you're going to have your same day or your instant payments, and the margin that you're paying that provider to execute the transfers. But the bigger picture with benchmarking is understanding your forward contract or your hedging strategy. And a lot of high street banks, for SMEs, that isn't a product that's actively pushed. They might provide it in the background, but it's not actively pushed to you as a business owner or a finance team. And the concept behind it and how they work, really, really, really simple products that should be utilized by anyone that's got exposure to currency risk. But how they're priced, how you utilize them completely depends on your requirements, and it'll be very, very bespoke to you. So whilst we talk about benchmarking from a payment and FX perspective, then there's also a really key piece around comparing how your hedging or your forward contract strategies were executed last year. Were they effective? Were they ineffective? And then working backwards from that to create a short-term plan for this year on how you can utilize those tools in a more effective fashion.